So today's Cardinal lesson, RMD aggregation, and we're talking about required minimum distributions. So most of you watching, you've been into the accumulation of your IRA or your 401k and the growth of it and building up a balance. And then when people come to us, now we're going to start getting an eye toward distribution or actually pulling money out of there. And as many of you are well aware, the IRS has a rule that starting at age 73 and above, you have to take money out of your IRA or your 401k, and it's a certain percentage and it has a whole bunch of rules around it. So that's RMDs, required minimum distribution. We have several other videos on that that you can reference where you really want to learn about the intricacies of that. And today's topic is really the aggregation. And what we mean by aggregation is if you have several IRAs and we've checked all the boxes and you can actually do this thing called aggregation, you can pull the distribution out of just one of those several IRAs for all the IRAs. So it's a feature that people come into and they're pretty confused about. So I want to turn it over to Tom to talk a little bit about this.
Yeah, I mean, I think one of the main reasons we're doing this video is we have a lot of people that come in and they have accounts spread all over everywhere. They might have 3 or 4 different IRAs at different custodians. They still have a 401k. They might have a 403b from a previous employer. Maybe they're inheriting money and they know they need to start taking money out of these accounts, but it is confusing of how they calculate and how they, what accounts do we need to take it out of? Can we take it out of one account? Do we have to take it out of all accounts? And so really what we want to do today in this video is just walk through some of the rules and try to help simplify the calculation process and for these RMDs, the required minimum distributions. And also just probably don't try this on home. If you have multiple accounts, talk to somebody that knows these stuff. You could call us and we can help you figure out how to do this. But we're going to bring up the show notes here and kind of walk through just real quickly. These show notes are in the link below of the video. They're also on our website. They're a great source of information. They get into more detail than what's on the board. So print them out, look at them if you're interested. But one of the things is you'll see is there's a lot of information of the different accounts, the different rules around all these different accounts. We have a nice chart here. We don't want to spend a lot of time going into all these details. Hans will go into more the specific, the important information when we go to the board. One of the things, and I use this often in just day-to-day my practice, is this chart in the show notes really goes through and lays out how to calculate if this is your IRA or your 401k. This is how to calculate your RMD based off your age. The chart below is how to calculate if you inherit money. Don't try this one at home. This one is more complicated in terms of the calculation process. It depends on when you inherit it, how many years ago did you inherit it. Again, don't try this one at home. But again, the show notes are really there to support what's on the board. So we'll hand it back to Hans, and you can kind of go through the important information listed on the board.
Okay. Yeah. So this side of the board, the left side of the board, goes over which accounts you can aggregate. And you can't cross over from systems. In other words, if you have an IRA, a traditional IRA, a pre-tax IRA, and you're 73, and you also have a 401k, and you got a minimum distribution for the 401k, you have a minimum distribution for the IRA, you've got to pull out the correct amount of money out of the 401k and out of the IRA. You can't mix and match those things. So that's what really this whole video is about, is what can you aggregate and what do you have to keep separate. So the first category we're going to go into is if you have a traditional IRA, and this would include your SEPs, the Simplified Employee Pension, which is just kind of a blown up IRA, or the simple IRA. So all of those can be aggregated. And if they're pre-tax and they're all on the same person, you have to calculate the RMDs separately. And many times the custodian will do that for you in your January statement. It tells you during this year, this is the amount you got to take out. And your 401k will do that if you're over 73 and you still have money there. And if you have several IRAs and you've got an amount on each one of those statements, or you bring them to us and we calculate it for you. And let's say you had 200,000 in one, 300,000 in another, and 50,000 in another. Well, then you could calculate the amount of minimum distribution due on each one of those three, and then you came up with a number like $10,000 or something, then you could pull the whole 10,000 out of the $50,000 one. You wouldn't have to go around and apportion that and take the right amount out of each account. That's what we're talking about with aggregation. So as long as they're the same type of IRA and they're either that or an SEP or a simple, you can aggregate the minimum distribution. Now, for Roth IRAs, there are no RMDs during the owner's lifetime, so there's nothing to aggregate. So don't be throwing these in with that, or don't be calculating a minimum distribution on your Roth, because you can just leave it in there, or you can take it out. There's no requirement on those for the owner. Now, on company plans, which are going to be your 401ks, your 457s, that kind of thing, but a lot of these are 401ks, and this excludes 403bs, which are the things that teachers and hospital employees have. The RMDs have to be taken separately. Okay, so if you had an old 401k and a current 401k, or maybe they're both old 401ks, but they're different places, you got to pull you can't do this aggregation business with 401ks. You got to pull the appropriate amount out of each account. And with 403bs, they have their own rules, and there are several teachers, several hospital employees that'll have multiple 403bs. And if they're still in what you set them up in, you have to calculate the RMDs separately, but then you can pull it out of whatever account that you choose. And this matters to some people because they might have cash in one account, or they might have time deposits, or maybe they have stock that they want to sell, or they just sold. And then this other account, they may have something that they want to keep, that they see future growth. So you could have reasons, multiple reasons, to want to pull money out of one account as opposed to others. So that's where account aggregation comes in. You just got to be careful that you're not throwing in things that are not alike and then doing this account aggregation business. So that's where we're talking to you, that you're the owner when you get to be 73, what you're going to need to be doing. Over on this side of the board, we're talking about inherited IRAs, and we have people come to us all the time. And I'm going to just use an example, a young lady whose father just died in December. He passed away, and he left her 5 IRAs. Okay, 3 of them were annuities, 2 of them were accounts that are invested in various things. She's got 5 accounts. She's watched my videos. She knows something about 10 years, and people are to some degree clueless about this. And we have other videos that'll get into the designated beneficiaries, non-designated beneficiaries, the 10-year rule, all that kind of stuff. But what we're going to be talking about here, again, is account aggregation. Is of this young lady with the 5 accounts, is she able to do aggregation? In other words, if we calculate the minimum distribution for 2023 on all 5 accounts and add it all up, can we pull it out of one account? And for her, the answer is yes. I think what she's going to do is she's going to roll all those accounts into one account, and then we're going to set it up so that she can't mess it up, that it's just going to distribute the money over 10 years because it's just happened. That's what we're working toward. But what this video is about is really, you need to be careful if you start mixing and matching these things, because you're going to make a mistake, and the penalties for getting this wrong are huge. So we want to talk about inherited IRAs. If we have different decedents, so that if her mom died 2 years ago, her dad just died, and they both left IRAs to her, you can't combine the minimum distributions out of those two accounts. You can't even combine those two accounts because it's a different decedent. But if it's the same decedent, you can aggregate them. Now we're going to talk about an inherited Roth IRA, because I said over there, there's no minimum distributions on Roth IRAs for the account owner for lifetime distributions. But there are minimum distributions for the beneficiary of a Roth IRA, and they're very similar to the other IRAs. You just don't have to pay any tax, but you can't leave all the money in there forever growing tax-free. So the IRS has the same rules of you pulling them out. You can't do different decedents. You can't put them together. But if you have the same decedent and you had multiple Roth IRAs that you inherited them, you could pull the ultimate distribution out of one account. The inherited company plans. So let's say that your parents left you, or your father, if this young lady would have left him or left her, the father left the lady like 3 401ks. He worked 3 different places, left the money there all along, had her as the beneficiary, and she now, each plan has to do their minimum distribution of their RMD separately. There's no aggregation when it comes to 401ks. And then for 403b plans, different rules. You can aggregate those as a beneficiary. So I want you looking at this side of the board first as a beneficiary of something that just happened or it's going to happen soon, and for you to understand that, because this is a problem that's here right now. I also want you to look upon it as, if your children or your spouse are the beneficiaries over here on your existing stuff and you're coming to us, we can set things up for you so this isn't such a hassle when your kids would be leaving, when your kids are inheriting your money. So I really want you looking at 2 ways. One is the beneficiary, one is the owner that's leaving your accounts. You can actually do something about simplifying all this now. That's really on both sides of the board. So I want to bring Tom back on, and I want to go over all the subjects that we covered here today. I mean, we covered taxes, because that's what RMDs, or required minimum distributions, are all about. We talked about estate planning, because we're talking about beneficiary IRAs. We're talking about income, because that's really what we're doing with RMDs, or required minimum distributions, is we're setting up income. And these are all about IRAs and 401ks. So Tom, is there anything that you want to say or that I left out of this whole topic?
Yeah, I mean, just a minor point, and I think one thing that some people can miss is an IRA is an individual retirement account. So you cannot combine spouses' IRAs for purposes of RMD. So if there's a husband and wife, the husband needs to do his own IRAs or RMDs, the wife needs to do her RMDs. And so you cannot combine those together. So when we're over on that left side of the board talking about aggregation, another thing you're not allowed to aggregate is different people's IRAs. And so that's just something to keep in mind.
My advice is, don't try this stuff at home. I mean, that's what we're here for. And that's what professionals like us, we understand this stuff and we understand your situation. And when you're over here and you're still with us, and maybe you're not even 2 RMDs yet, we can combine accounts and we can roll things over tax-free to get this, so it's going to be a lot simpler for you when you're 73.
I mean, I think a good goal moving into retirement is to simplify your life. So having a lot of accounts out there is just complicated. So when available and when it makes sense, sort of combining them, maybe rolling a 401k to an IRA or combining IRAs, I think just makes sense because it's less hassle to keep track of. It's less work for your beneficiaries when you ultimately pass away. So I think when available, combining accounts generally makes sense.
Sure. And with that, I'm Hans Scheil.
And I'm Tom Griffith.
And we thank you very much for listening to us.
Thank you.